Welcome back to the deep dive. You shared the sources, and we are ready to unpack what is really one of the most compelling head-to-head battles in the consumer sector right now. This is the classic story, right? The massive, entrenched industry giant versus the nimble, focused specialist.
Exactly.
Our mission today is to really analyze the investment case between two beverage titans, Coca-Cola, ticker KO, and Monster Beverage, MNST.
And the hook is right there in the performance.
Oh, it's impossible to miss. The thing that likely jumped out at you in the data is just incredible stock performance difference over the past year. Monster Beverage's stock gained an eye-watering 45%.
By 5%.
Which just completely overwhelmed the, very respectable 12% advance that Coca-Cola made.
Right.
So before anyone just rushes to chase that momentum, the core question we have to answer for you is this. What do the underlying business models, the sheer difference in scale, and most importantly, the strategic tie-ups, tell us about where the true long-term value might be?
That gap, that 45% versus 12%, is the perfect way to frame this whole deep dive. It's a classic contrast. On one side, you've got scale, stability, and dividend power with Coca-Cola. And on the other, you have the niche focus, that rapid growth potential, and frankly, the volatility of Monster.
So to understand that difference in performance, we need to go deeper.
We have to. We need to move past the immediate stock price and really look at the foundational economics of these two companies.
Okay, let's start with the undisputed giant first, the $300 billion elephant in the room, Coca-Cola.
Yeah.
It's just immense.
It's hard to even wrap your head around that scale.
We're talking about the world's largest non-alcoholic beverage company and the fourth largest consumer staples company globally. That number, $300 billion, it isn't just a market cap. It represents total global dominance.
And that dominance is baked right into its structure. People think of Coke and Diet Coke, but the portfolio spans pretty much every beverage category: sparkling, water, juice, coffee, tea.
Oof.
But their true strength isn't just having famous brands, it's the operational machine behind them. Their marketing is unmatched, yes, but their innovation and, crucially, their global distribution capabilities. That is the real moat protecting this business.
That global logistics network is...
Yeah.
It's often overlooked.
Yeah.
But if you stop and think about it for a second, it's mind-boggling.
It really is.
They can get a refrigerated product to a tiny store in the middle of nearly any continent on Earth. I mean, who else can do that?
Nobody. Precisely. And that sheer size, it isn't passive. It's a strategic weapon. Coca-Cola acts as the industry consolidator.
Right.
They don't have to spend years and, billions trying to innovate a new category from scratch. If a niche beverage takes off, say, specialized coffee or some new health drink, KO can just use its massive financial power to acquire it.
And then just plug it right into their global system.
Instantly. That acquisition strategy is what keeps their portfolio perpetually relevant.
That sounds almost inherently protective, It creates a kind of floor under their performance. And speaking of enduring strength, you cannot discuss Coca-Cola without highlighting its legendary status as a Dividend King. This is where that stability part of the equation really shines.
It's historic. KO is tied for the 5th longest dividend streak among all publicly traded companies. We're talking 63 years of continuous annual dividend increases.
That's 3 years.
That's not just a financial metric. It tells you about the consistent, reliable cash generation of the business, no matter what the economy is doing.
So if we look at the financials that actually feed that dividend streak, what do the sources tell us about KO's growth profile?
Well, the profile is exactly what you'd expect from a stable giant. Over the past decade, their revenue has been pretty stable, but their earnings, the bottom line, have grown at a compound annual growth rate, a CGR of around 4%.
Okay, so 4% might sound slow to some people?
It might, especially compared to a tech stock, but think of it this way. 4% growth on a $300 billion valuation generates massive amounts of reliable cash flow every single year. It's the sound of a cash register that is just perpetually ringing.
Consistent, predictable.
And remarkably resilient. That's why value investors absolutely love it.
So we have scale, consolidation power, 63 years of stability, and 4% reliable earnings growth. That really defines the stable side of this equation. Now, let's pivot to Monster Beverage. If Coca-Cola is the giant ocean liner,
then Monster is the high-speed speedboat.
Exactly. We're moving to the complete opposite end of the size spectrum here and shifting focus to a specialist.
It's a great analogy. Monster is a relative newcomer, and they have been just incredibly successful by focusing almost entirely on niche, high-growth categories, primarily energy drinks.
And while energy drinks are their core, The sources show they're strategically trying to use that foothold to expand, much like KO uses acquisitions.
Right, they're branching out.
Monster's portfolio is moving into other high-margin areas like water and even craft beers.
Yeah.
Their whole model is built around establishing a hot, culturally relevant brand in one niche, and then leveraging that popularity to build out a broader business.
That niche focus is so vital to their story. Monster has been masterful at marketing not just a product, but a lifestyle.
Yeah, they tie into subcultures.
Exactly, like extreme sports, gaming, competitive esports. This lets them completely bypass the traditional mass marketing scale of a company like Coke and hit these highly engaged, really focused consumer groups.
And if we contrast the size here, it really highlights that difference in scale. Monster's market cap is roughly $75 billion.
Which is significant for sure.
Absolutely. But it's a quarter of the size of Coca-Cola. And this leads to a really critical point of tension and dependence that we have to talk about from the sources.
Yes, this is key. Monster could not achieve its current global reach without riding on the coattails of the giant we just discussed.
Right.
Coca-Cola's vast distribution network is actually a vital partner for Monster. They distribute their products worldwide. So Monster is a fantastic product and marketing company, but it relies on KO's pipes to move the goods.
So since they started from a much smaller base and captured this rapidly growing niche, it makes total sense that Monster has grown more quickly. How fast was that historical growth?
It's been phenomenal. Through the end of 2024, the sources show Monster's sales and earnings grew at an impressive compound annual growth rate of about 12%.
12%. That's 3 times the rate of KO.
Exactly. That's why the stock has performed so well. They are capturing category growth and market share at the same time.
But the sources also inject a necessary note of nuance here. The 12% is historical. And as the company gets bigger, as it gets closer to that $75 billion valuation,
But that growth rate is predictably slowing down.
right, it has to. It's just harder to grow 12% on a $75 billion base than it is on a $10 billion base.
Absolutely. And just like their focus on growth sets them apart financially, their investor appeal is completely different. Monster doesn't pay a dividend. They are taking all their available cash and just reinvesting it aggressively to fuel that 12% growth. Again, it reflects that pure growth focus that appeals to a very different shareholder than KO's Dividend King status.
So here's the mystery we need to solve. We have the Sable Giant growing earnings at 4%, and the Specialist growing historically at 12%, though it's slowing. That 8-point difference is what drove that 45% stock gain.
Right.
So the core conflict now is decoding this valuation disparity. What price are investors actually willing to pay for that speed?
And for that, we jump straight to the valuation metrics. The main one we look at is the price to earnings, or PE ratio.
Which basically tells you how many dollars you have to pay for $1 of a company's annual earnings.
Exactly. And the numbers here are, well, they're shocking.
Monster's PE ratio is at a steep 44 times earnings.
While Coca-Cola's is significantly lower at 23 times earnings.
That's almost double.
It's an enormous difference. Now, we have to acknowledge that a faster-growing company should command a higher multiple. The real question is the current premium justified?
Okay, so let's analyze the historical valuation of Monster to answer that. And this gives me pause. Monster's valuation ratios, its PE, its price to sales, its price to book, are all currently above their 5-year averages. So based on its own history, the stock looks historically expensive right now.
To put that 44x PE into perspective, the sources note that Monster's long-term average PE is closer to 37 times.
Okay.
So even if the stock simply reverts to its historical average, meaning the company keeps executing flawlessly, but the valuation premium just shrinks a bit, it still faces a potential headwind. You're paying a premium on top of the usual premium.
And in stark contrast, Coca-Cola looks reasonably priced. Its price-to-sales ratio is right in line with its 5-year average. And critically, its PE and PB ratios are both currently below their 5-year averages.
And that is the key distinction. KO is priced fairly, maybe even conservatively, against its own history, offering stability and income.
While MNST is priced aggressively against its own history, offering high growth potential but demanding a massive valuation premium to get it.
So the two camps of investors are clearly drawn. Growth investors, the ones prioritizing momentum, they're going to lean toward Monster because of that faster growth rate, despite the steep price.
Meanwhile, conservative, dividend, or value investors are going to favor Coca-Cola. They get a reasonable price point relative to KO's own history and above-market dividend yield.
Currently sitting at 2.95%. You are getting paid almost 3% just to wait.
Okay, but here's where the analysis moves beyond that simple categorization and becomes genuinely insightful.
Mm-hmm.
We have to introduce the final critical strategic twist because it completely changes the growth versus value argument. It turns this whole choice into something much more nuanced.
This is the tie that binds the entire sector together. Coca-Cola, the slow-moving consolidating giant, owns a massive, significant stake in Monster Beverage.
Around 21%, according to the sources.
21%.
So we're not just talking about a partnership where KO distributes the product. We're talking about KO being a major foundational shareholder in their supposed competitor.
And that 21% ownership just changes the entire decision tree for a value-focused investor. The sources suggest a really potent practical application here.
Okay, what is it?
By investing in the more reasonably valued Coca-Cola, the stock trading below its historical averages and offering that reliable dividend, an investor automatically benefits from 21% of Monster's higher growth potential.
So you get the stability, the dividend, and the global dominance of KO,
Okay.
while simultaneously capturing a huge chunk of that 45% stock surge we saw last year, but without having to pay Monster's historically high 44x valuation.
Exactly.
It's like buying the entire beach, but you get a slice of the competitor's trendy boardwalk stand thrown in for free.
That's a perfect way to put it. The strategic relationship essentially de-risks the Monster investment for a KO shareholder. If Monster continues its extraordinary run, KO benefits significantly. And if Monster hits some turbulence, well, the KO investment is protected by its sheer scale, its vast portfolio, and the resilience of its 63-year dividend stream.
So let's review those key differences for you one last time. Coca-Cola offers massive protective scale, decades of reliable dividend income, and that unparalleled distribution power. And right now, it's reasonably priced against its own history.
While Monster Beverage offers that high growth potential and niche market leadership, but you are paying a very steep price for it, sitting well above its historical valuation averages.
And that comparison really brings us full circle, doesn't it?
It does. We've pitted the $300 billion giant, with its 63 years of dividend increases and its 4% earnings growth, against the $75 billion specialist with 12% historical KGR growth, but which carries that steep 44x PE ratio.
So if you look at this setup, KO's valuation looks reasonable. Its size allows to capture a fifth, 21% of Monster's higher growth anyway, and it handles the distribution. What does that tell you about the long-term value of scale and consolidation in the beverage industry?
It seems like the giant is always positioning itself to win.
Regardless of which way the consumer trend blows.
And this raises the single most important question from these sources. While the specialist, Monster, drives the innovation and captures those rapid, dramatic stock gains that grab all the headlines, the industry giant, Coca-Cola, uses its immense financial and distribution muscle to capture a significant piece of that growth, even acting as the key logistics partner. So when the giant is also a major shareholder, can the smaller company truly outrun the overall consolidated sector? Or is Monster, fundamentally, a highly successful, high-growth subsidiary that just generates profits for its stable, dividend-paying parent?
That is something fascinating to mull over as you weigh stability against pure growth in your next potential investment.
A deep dive complete.
Thank you for sharing your sources and letting us unpack the true dynamics of this beverage battle. We'll see you next time.